Hi, my name is Jim and I was retired. In this video, we're going to continue to look for ways to reduce taxes in retirement by moving money from tax-deferred to tax-free accounts. In this video, we're going to use my DIY Retirement Withdrawal Strategy Spreadsheet for figuring out your Roth conversions. Some quick notes about Roth accounts. While you're working, there are limitations to the contributions you can make to Roth accounts. Generally, you can't contribute more than $6,000 combined to your IRA and your Roth IRA. And if you're over 50, those limitations are increased to $7,000. But that's it. No more contributions above those limits. Plus, you have to have earned income to contribute to a Roth account. And if you earn too much, those contribution limits are eliminated. For single filers, the allowable contributions start to phase out with adjusted gross income above $124,000, and you cannot contribute anything if you earn more than $139,000. And for married couples filing jointly, the phase-out begins with AGI income above $196,000, and you cannot contribute anything to a Roth if you have more than $206,000. Roth conversions, on the other hand, do not have any income limitations, and you can convert any amount of your tax-deferred assets without penalties or limitations. You just need to pay the ordinary income on the amount that you convert to a Roth IRA. If you're under the age of 59 and a half, you need to pay the tax with other income, not your tax-deferred assets, since that tax payment would be subject to the 10% penalty as an early withdrawal. That extra tax on a tax is never worth it. Now, once you convert the money to a Roth account, the earnings will be subject to 5-year waiting periods to ensure the money is tax-free when you withdraw it. A Roth conversion is technically not a withdrawal, so as you think about your retirement withdrawal strategy, or even a simple rule like the 4% rule, you are not spending this money. You are converting tax-deferred dollars into tax-free dollars for use later in retirement. So, how does it work? Let's look at the spreadsheet. I've simplified my DIY retirement withdrawal strategy spreadsheet for this base case. I've reduced the number of columns so that our couple has only one tax-deferred account, one Roth IRA, a taxable brokerage account, and a savings account. Just as in our kitchen counter example in the last video, this couple has $2 million in retirement savings, and that's divided up into $1.5 million in an IRA tax-deferred account, $200,000 in a Roth IRA, and another $300,000 in taxable accounts, which I've divided up between $250,000 in a brokerage account and $50,000 in savings. So let's take a look at the input page on this spreadsheet for the information about our couple. I've entered the age for our couple. They're 65 and 60, and they are making, with their overall portfolio, a 5.23% real rate of return. Inflation is 2%. I've said Social Security will begin at 70 for our main retiree, with the spousal benefits beginning at the spouse's age of 67. And a small pension begins at 65, $24,000, once the older worker reaches 65. In our base case, I've also considered that expenses will be $80,000, moving up with inflation through retirement. And I've also assumed this first year that the pension plus some withdrawals from taxable accounts will meet those expenses up until the point that RMDs, required minimum distributions begin at 72. Now, if you need a refresher on how any of these columns work, please refer to my 4-part DIY Retirement Withdrawal Strategy series, and I'll put links in the notes below. I will pause to take a look at these columns over here. Look at these 4 columns here: gross income, taxable income, estimated tax rate, and estimated taxes, because I've changed the way these formulas work. And let me show you how I've done this so that the standard deduction will go up with age as each of our couple turns 65. The gross income used to be called taxable income in my prior sheet, but as many people pointed out, it was really closer to AGI. And so now that is exactly what it is. It adds up all of the taxable income sources and creates that. Let's take a look at the taxable column now, and particularly this formula down here: gross income minus, if your age is 65 and over, use that extra $1,300, otherwise zero, plus if spouse's age 65 or over, take that $1,300 and add that to the standard deduction as well. And so when you add all of these things up, once both are over 65, the standard deduction will be $27,700. And that extra $2,000 or so there really adds up as you run through this scenario. If you look at the taxes page on the spreadsheet, you'll also see that I've eliminated state income tax. I've just focused on federal. The retiree couple could be retiring in Florida or Texas. So let's just focus on federal taxes for this example. Now, in our base case, which all I've done is try to solve for meeting expenses. So the surplus line column over here, I've tried to get as neutral as possible. So that's all I've done here. If you look at the tax rates, you'll see that it begins at 10%, jumps to 12% for a little bit, but once RMDs get added to Social Security, they're in the 22% and then the 24% from most of their retirement. And by age 90, that's the other thing I've done to this spreadsheet. I've cut it off at age 90 for this example. Let's see the taxes that they have paid to the IRS, $913,000 in taxes. Is there any way to reduce that amount? Well, let's begin small, and we're going to take a look at some Roth conversions to that base case. And here I'm going to show you a little bit what I did. Instead of solving for the surplus column out here, which again I've tried to be as neutral as possible, but first thing I did was take a look at where the gross income would be without any Roth conversions, and then how close can I get to the limit on gross income before the tax bracket changes. So can you fill up that part of the tax bracket with some conversions? And so in this year, 16,000, and I'm going to say I'm going to convert all of it. And therefore I'm going to withdraw $51,000 from brokerage to pay that tax plus the expenses that I need in addition to the pension to meet expenses. And I'm going to solve through this. And it really is a trial and error. This really is an art form to take a look at where the gross income would be without the conversion, and then just convert enough to ensure taxable income stays in the current bracket. I've done that through the 10%, 12%, 22%, and I've stopped at the 22%, and for the final years, just let nature run its course. And you see that you're only saving about $56,000 over the base case with those modest Roth conversions. But can you do anything more extreme? Well, let's take a look at some extreme Roth conversions. And in here, same principle. I tried to go, instead of to the top of the current bracket, I've said, well, let's see if we can go to the top of the 24% tax bracket for a few years and eliminate all RMDs. So once the couple does that, they've saved more than $206,000 in taxes with this scenario. And it begins at 24%, and then they go to 12%, and then 22% for the rest of their retirement. But there are some caveats with this. Let me show you. If you take a look at this, and I've introduced this in the prior video and showed that these are just picking up the columns from the appropriate scenarios, and then this is a running total of those. And if you look down here, the break-even point for Roth conversions is down here. It's pretty far. And the extreme is a little worse than that. Also, if you look at where our couple is with those extreme conversions, they are about $1.5 million off of the base case example of retirement assets. I'm not sure paying out all those taxes in the first 5 years makes sense. Here's another summary of that that I've looked at. The base case at 72 and 90, some modest conversions at 72 and 90, and the extreme at 72 and 90. And you can clearly see that paying those tax bills up front in the early years puts a severe drag on the portfolio growth. And also recognize that those very large conversions will likely cross several tripwires. For instance, as soon as income exceeds $80,000, capital gains jump from 0 to 15%. And if you're relying on those taxable accounts to generate some returns, that means more taxes on dividends and capital gains from those accounts. And once you hit the $107,000 in gross, your tax bracket will jump to 22. And as soon as you hit $176,000 in income, you get an IRMA surcharge on your Medicare premium that adds about $700 a year. $199,000, your tax bracket jumps up to 24%. $222,000, the IRMA surcharge goes to $1,782 a year. And if you hit $276,000, your IRMA surcharge adds $2,851 a year to your Medicare premiums. All of those are hidden taxes as your income goes up. Now, here's an example where I have tried to take in some of those tripwires, and I've tried to keep taxable income below the tripwires. And let's see if that helps. And it goes through the same process of solving for gross income and taxable income to avoid the tripwires. And you see, it only saves a little bit more than the first example that I gave you. In this case, it's $79,413 less than the base case in taxes paid over the life of the retirement. But again, back to that chart I showed here, you end up with about the same as the base, a little less, maybe about the same as the first conversion. The other thing to think about is that smarter Roth conversions, the break-even point against the base case is actually worse. It's 25 years versus 21 and 22 for the other two examples. You know, in my mind, simple, small Roth conversions to the top of your current tax bracket in those early tax brackets, the 10, 12, maybe some of the 22, that's it. Modest savings on your taxes, but don't try to eliminate RMDs. You're likely to run into too many tripwires with those kinds of strategies. You know, another question to consider is when in the year is the right time for a Roth conversion. Some people say early in the year to give your Roth investment time to grow. And others say the end of the year so you're sure of your tax brackets. I'm in the later camp. Late in the year also gives you an edge because the 5-year clock of Roth conversions starts on January 1 of the year you open the Roth or make a conversion, even if that doesn't happen until December. And so in essence, your 5-year clock is about 4 years and a few months. And about those 5-year rules, there are 2 of them. One, your first Roth IRA must be at least 5 years old before you can make qualified withdrawals. So set up a Roth as early as you can. And the second is, for those under the age of 59 and a half, each Roth conversion triggers its own 5-year waiting period. After you are 59 and a half, only the 5-year age of a Roth account counts. I'll conclude with my standard warning. I am not an accountant or a financial planner. I have no special initials after my name. So take this as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional advisor if you need one. Hey, and be sure to like and subscribe and comment below. Are you considering Roth conversions? Are you going big or going modest? Let me know. By the way, if you click and like and subscribe, this shows up higher in the search results. See you next time.